Let's talk about why you should get into debt in 2024. Purchasing a home with a mortgage is a smart financial decision. And in many, if not most, cases, even with things like real estate fees, property taxes, and interest on a home, you more than likely will make money on that asset that your mortgage affords you to buy. The home. But purchasing debt is a smarter financial decision. What do I mean by purchasing debt? If you're the type of person who spends months or years getting themselves out of credit card or student loan debt, the very thought of taking your money and getting even more of it probably mortifies you. And yet, that would be a pretty bad deal. Who would want to buy themselves into more debt? But that's not what I'm talking about, though. When you get into debt the right way, it can be relatively lucrative for you, particularly if you have a plan. And if you compare it to the debt that you're getting into with a home purchase, you'll be wondering why you didn't think of this before. Let's get into the details. The right way to get into debt. I am a fan of getting into debt. You're probably wondering why any sane person would want to get into debt. Well, the answer is for the same reason you want to get into crypto or stocks or REITs, because getting into debt the right way can actually make you money, especially if you know what you're doing, particularly if you're doing it right. So by now, you probably know I'm not telling you to whip out your favorite high-limit credit card and go on a spending spree or an exotic vacation or buy a luxury automobile that you can barely afford, or even to get a house. No, I'm talking about debt instruments. That is, taking your money and purchasing debt that someone else is trying to get. In layman's terms, you're purchasing the right to be the person or the thing that someone makes interest and principal payments to. Or the way I like to think about it, you're the bank issuing their credit card, car loan, or mortgage, in a manner of speaking. Now, how can one do that? There are several ways, actually. Let's talk about some of the more popular ones, starting off with certificates of deposit. Me personally, I'm a huge fan of CDs, commonly known as certificates of deposits for all you financial nerds, especially when used in a CD ladder. CDs are like high-yield savings accounts, oftentimes with better returns, while simultaneously being FDIC insured to a certain level. They have a fixed term and a fixed interest rate, or APY, giving you an accurate and predictable return with minimal volatility. And if you ladder them as well, and by ladder them, I mean invest in multiple certificates of deposits, each with a different maturity date, and at the same time, roll over the profit from one CD to the next, you can achieve relatively, I'm not going to say excellent, but very good returns that most people don't expect. You can receive a pretty good return on your investment with minimal risk. I'm not saying no risk, but minimal. Now that's the kind of debt that I'm talking about. The risks are minimal, but they still exist. With anything, there are some downsides. If you take your money out before the term is over in a CD, there can be penalties and fees applied. In addition to that, while they do have pretty good rates of return, it's not the kind of rate of return you could expect from, let's say, an S&P 500 index fund over a 5 to 10 year period. They are good for many things, but in my opinion, they are good for saving short term, especially when applied as a mechanism to get your credit into the stratosphere. That's a separate video for a separate time. Maybe I'll put it in the card above, maybe I won't. It all depends on how I'm feeling when I'm editing this thing. Now, CDs aren't the only game in town. As a matter of fact, other debt instruments can be even more lucrative. For example, government bonds. You know how everyone is always complaining about how the government is always in debt? Well, it could be in debt to you. Think about that if you've ever owed money on your taxes. What's the saying? Turnabout is fair play? So in the strictest sense, these are debt securities issued by national or local governments to raise capital. They're considered relatively low risk, making them a popular choice for queasy investors. Just like CDs, these can be laddered to amplify your gains. And they're not the only game in town. There's corporate bonds. Corporate bonds are issued by companies to raise funds for various purposes. Corporate bonds offer higher yields compared to government bonds, but because of that, they also come with a slightly higher level of risk. And remember, no risk, no reward, which brings me to an important point. As someone that is looking to protect and really grow, as much as possible, doing due diligence on who you purchase bonds from, both corporate, government, etc., well, that's now your responsibility. You're effectively looking at the bond issuer's credit score and income statements to assess whether they are good enough to get some of your money. Kind of like how credit card companies and credit bureaus are looking at your credit score to determine if you're the kind of person that should be given more money. Like I said, turnabout is fair and fun play. Some of the more popular type of debt instruments include municipal bonds. Municipal bonds are issued by state or local governments to finance public projects such as school or infrastructure. They often offer tax advantages, making them attractive to investors in higher tax brackets. You also have Treasury Bills. T-bills are short-term government securities with maturities ranging from a few days to 1 year. They are considered one of the safest debt instruments as they are backed by the full faith and credit of the U.S. government, whatever that means to you. It's really just the beginning of the debt instruments that are available to you as an investor. There are other less commonly discussed types of debt instruments that have a more extreme risk profile, if you're the kind of person that loves a good adventure. For example, there's credit card debt, student loan debt, auto loans, asset-backed securities. Let's take a look at credit card debt. Credit card debt can be bundled into securities known as asset-backed securities. You, as someone who's looking to get into debt, you can actually invest in these. Let's take a look at how to invest. Investors can invest in asset-backed securities through mutual funds or exchange-traded funds, ETFs. that focus on asset-backed securities. These funds pool money from multiple investors to invest in a diversified portfolio with that particular focus. Speaking of asset-backed securities, you may have actually heard of this debt instrument. What am I talking about? It was all the rage back in 2008. What am I talking about? I'm talking about mortgage debt-backed securities, MBS. As you may know, they were quite the focus of the 2008-2009 financial crisis. That said, they're still a popular way to get into debt and to profit from it. Because you see, mortgage debt is often securitized into mortgage-backed securities, which represents a claim on the interest and principal payments from a pool of mortgage loans. If you buy a house and your neighbor buys a house and you both use mortgages to purchase that house, what oftentimes happens in that scenario is the banks that you guys got those mortgages from, they take those mortgages and they repackage them in a sense and then sell them on an open market. Now, this type of debt famously kicked off the 2008 mortgage crisis. Banks who issued mortgages took those mortgages, combined them with other mortgages, and then sold them to investors like you and me, but more likely institutional players like Bear Stearns. However, the mortgages that underlied those instruments were a little shaky, as they were issued with minimal requirements on the borrowers and other circumstances. Things like proof of income was not there, lower credit scores for some of the borrowers. When the housing market started to go upside down and people abandoned their homes rather than pay their mortgages, those same mortgages became worthless. People who saw this coming and either got out of those instruments early or shorted them, like Michael Burry, made a fortune. Others lost their shirts, like Bear Stearns, AIG, and a number of other financial firms. And if you were just a regular individual at the time, you likely felt some pain in some way as the ripple effect throughout the economy either affected you in either loss of employment or inability to find employment. Or if you had and kept your job, you likely lost money because your investments went through the floor. All that to say that vetting to whom you are getting into debt with is very important. And now you know why getting your credit score as high as possible is very important for getting a good rate on a mortgage. And if I haven't scared you off yet, you can access the mortgage market and invest in mortgage-backed securities through mutual funds or ETFs, similar to asset-backed securities. And I believe you can actually directly purchase individual MBSs. In addition to that, government-sponsored entities like Fannie Mae and Freddie Mac, they issue MBSs. One of the good things about mortgage-backed securities is that they are one of the more liquid types of debt you can get into. Not as liquid as corporate bonds or treasuries, but if you want to get into them, you shouldn't have an issue selling them once you have them if you want to get out. And one of the downsides is the aforementioned risk, as well as the relative complication, both understanding them and the complication purchasing and selling them. Now, it goes without saying that different types of debt instruments carry varying level of risk. Credit card debt, for example, may be riskier than mortgage debt. If you're looking to get in this sort of thing, you should assess your risk tolerance and your investment goals. This is because economic conditions and interest rates can impact the performance of debt instruments. And understanding what moves these things, for example, the Fed and the Fed's rate decisions, understanding all that is crucial for making informed investment decisions. And oftentimes, to get into these instruments, you need to buy mutual funds and ETFs. They're common vehicles for gaining exposure to debt instruments. And it goes without saying, if you're going to get into debt in 2024, you definitely want to consider investing in safer instruments. And if you feel like you're getting exotic and getting wild, you can begin to explore and invest in debt instruments that are a little bit on the higher risk profile. But diversifying your investment mix in debt instruments, just like stocks, bonds, and crypto, can help to mitigate the impact of poor performance in one investment or in one debt sector. You also want to keep in mind, getting into debt the right way is really only one part of a well-rounded investment strategy, especially with some of the safer types of debt that you can get into. Individuals with longer investment horizons, you really should avoid putting the bulk of your investment capital into these kinds of instruments. And really, you should focus on investments with higher risk profiles, but higher reward profiles, as that is how you will grow your wealth, especially if you invest in broad-based index funds that track the larger stock market. That said, though, less risky debt instruments, CDs, government bonds, corporate bonds, can be a great way to grow your savings, especially if you're looking to avoid the trap of perpetually paying interest. I have a video about that should be popping on your screen right now that you should check out. And remember that a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Derek West is Finance Squared. Like, subscribe, turn on post notifications, and I'll catch you in the next video. Peace.